U.S. natural gas pulls back despite the bullish EIA report, which indicated that working gas in storage declined by 6 BCF from the previous week. Today's EIA report is crucial, with survey estimates varying significantly, predicting a storage change between 0 to 9 billion cubic feet per day. However, the actual data surprised the market by revealing a -6 billion cubic feet per day withdrawal instead of an increase, pointing to a strong bullish trend that could push natural gas prices higher as the heating season nears. Despite the bullish EIA storage report, prices pulled back to the $2.20 support level after the weekly EIA update showed that total U.S. natural gas consumption dropped by 8.1% compared to the previous week. The total supply of natural gas also declined, but only by 1.8% compared to the previous week. As a result, the overall market balance shifted to a bearish stance. Nevertheless, I believe this bearish shift will be short-lived. The next three reports are expected to sustain bullish momentum, with the gap between historical and projected storage levels likely to widen as the month progresses. This increasing divergence points to a tightening market, which could provide further support for natural gas prices. By the end of the month, this trend may signal a significant shift in supply and demand dynamics, reinforcing the bullish outlook as we move into the latter part of the year. Meanwhile, a new wave of planned maintenance is coming in September and could put upward pressure on European prices, as well as global LNG prices, as competition for cargoes of the super-chilled fuel could rise. Early this summer, unplanned outages sparked several rallies in Europe's benchmark gas prices. The unplanned outages highlighted the vulnerability of Europe, relying on natural gas imports, as Norway became Europe's top gas supplier after the slump in Russian gas exports to Europe. Moreover, Europe's record gas surplus inherited from last winter has been largely eliminated following an unusually small accumulation of inventories so far in the summer of 2024. As a result, the threat of storage space running out before summer ends has been almost eliminated, which has lifted both spot gas prices and calendar spreads from relatively depressed levels earlier this year. The recovery in front-month prices, likely driven by traders and investors, has prompted some analysts to question if it is overshot, though a return to February and March lows seems unlikely unless the upcoming winter is unusually mild for a third consecutive year. From the technical point of view, nat gas failed to settle above the strong resistance level at $2.25. Nevertheless, the RSI indicator is in moderate territory, so there is plenty of room to gain momentum. If prices settle above the $2.25 level, they will head toward the next resistance at the $2.30 level. If prices drop below the $2.20 level, they are likely to head toward the next support at $2.10. Please like, subscribe, and comment to support the channel. See you in the next one.